one of the things that we did in St. John project, and we're doing it in every other multifamily value add that we're doing, is transferring the utilities to tenants as much as possible. Submetering the water, submetering electricity. We're cutting gas or anything else like in the buildings typically. We electrify the buildings is one of the ways that we achieve the energy efficiency and GHG emission reductions requirements for MLI Select program. So we add value that way. We also do things like providing Wi-Fi for tenants and charging them a fixed amount. And we make this spread from we get the bulk connection per se, and then distributing that between the tenants. So we do things like that to really push the value up and lower the expenses. So that was one of the things. And also the rent improvements, like the renovations, kind of typical what we do. So that's where we were able to push the value up to 1.3 million.
What's going on? Welcome to the Rise Real Estate Investing Podcast with your favorite host, Mayutaba, and your secondary.
Secondary means least favorite host, Austin Gay. I had my run in 2021. How's it going?
What's going on, Austin? What have you been up to, man?
What have I been up to? A lot of phone calls, client calls. I guess there's a ton of pre-constructions closing. No surprise, right? So a lot of pre-qualification going on there. Sent out a couple of deals on the wholesaling side. We did some more marketing, had a few calls, a lot more realtor referrals than actual closings herself, but that's okay because at least that's some sort of income and that will cover at least some of the marketing costs.
Yeah.
We haven't historically moved mobile homes, but we sat to the mobile home and we had a couple of interested parties, seriously parties.
In selling or in buying?
Selling it.
Interesting. How much did it go for?
It went for, it hasn't closed yet. I'm not going to say anything, but we have signed it. And it went sight unseen, and we got 2 sight unseen offers, which is quite surprising. It's the purchase price, right? Because it's significantly less than 100,000. So people can just buy it in cash. But we've always sort of strayed away from mobile homes, but thought would give this a shot because one of our partner Bird Dogs, which is hey, let's send it out anyways. And I guess that thing that we're going to entertain now. Other than that, dude, I'm just trying to figure out what else.
These are people buying it for rentals or for their use?
Flipping. Yeah.
They're going to flip a mobile home park.
Not a park, a mobile home.
Oh, mobile home. Interesting.
Yeah. I've heard some people do it before. I've never gotten into it. Obviously the margins are going to be tighter because, I'm not going to say margins are going to be tighter, but your max profit margin is going to be capped.
But your financing costs are going to be way lower. Your holding costs are going to be way lower as well, right? So it actually seems like a pretty safe way to flip if you ask me, because what's your worst case? Turn this into a rental, maybe get $1,000, $1,500 a month on this, right? It's not terrible.
I don't know how the mobile home rental market is, to be honest with you. And I can imagine the tenant quality is probably a little bit
AAA only.
A lot of them are owners in the mobile home. They're owning something that's low six figure.
So you're stereotyping all of them, but it's definitely true. I think I looked into some on these leased lands of okay, what if I bought one of these for 100? I think they asked 100, 130 on the MLS and stuff, right? So obviously more expensive than what you're talking about, but you could still cash flow in theory really well. The biggest risk is what's my land lease going to be in a couple of years from now, right? And what happens with that?
The appreciation is just not.
Yeah.
It's going to appreciate by sheer luck. It's just by everything ripping.
That's the market as a whole, right? If the entire market continues to get more expensive, then these mobile home parks will be more expensive as well.
Exactly. I think part of it is that you want to, we had this conversation with Ning, right? And on our podcast, there was when you invest for appreciation, or that's an important element, which it should be for all of investors. It shouldn't be the be all end all. You want to do it such that you're able to outpace the appreciation around the city as well. I think that's pretty, right? So location matters as well. But for an entry level investor, not about it, actually.
Yeah, for sure. Interesting.
How about you on your side?
Yeah, shit. I don't even know, man. I think, things have been, moderately busy on the mortgage side. It's not extremely busy. It's not extremely dead, right? So that's good. Trump stats or the GTA stats were out, and they were talking about volume being down year over year. I was kind of surprised about that, but I guess we're comparing to like last year's spring was actually a pretty big rip in the market.
This when I started ripping, like from April to May.
Yeah, and then we're also seeing bond yields go up a little bit, which is it's weird though because we're seeing bond yields go up and then rates kind of stay where they're at, but we'll see kind of the sustainability of it. Where's your head at with these rate cuts?
Yeah, so someone just actually asked that. I made a post about it, and they were inquiring where I see rates going. Like, I always hate these crystal ball questions, right? Because no one ever really gets it right. But in a sort of my thoughts is obviously it's going to be dependent on what the U.S. does. Like, we can diverge from the U.S., but like if the U.S. does 25 bips, are we really going to be doing 7,500 bips? I don't think so.
I think we already diverged though, didn't we?
Not necessarily. We've been pretty lockstep with the U.S. for the most part. Right? Like if the U.S. doesn't decide to cut rates at all this year, does that leave runway for Canada to cut rates? I don't think so. It's going to be inflationary, currency devaluation, et cetera, et cetera. I think, but I mean, it still seems like Jerome Powell was out yesterday saying that they're going to have to continue to wait for inflation data to come in before they have the confidence to cut rates. But that being said, the market still expect 3 rate cuts this year from the Feds despite that. So, I mean, if we're just looking at what the market thinks, I mean, we can lean towards 3 rate cuts in both Canada and the Fed. But who knows? It keeps getting pushed out.
No one cares what the market thinks, Austin. What do you think?
What do I think? I mean, I think they're going to cut rates. But that being said, I also wouldn't be surprised if they don't, because the U.S. is just performing so strong. Right?
Yeah.
Like economy is doing well, labor's resilient, Canada's rolling over. Canada is like totally opposite from the US right now. I think Canada needs to cut rates, but I don't know if they'd be able to if the US doesn't. But I do see the like rates. I just don't know if they'll do 75 pips.
Yeah, I'm kind of jealous of how good things are going in the US right now. It seems like it's been pretty freaking it's been remote, man. And like whenever I see clients that have like the 2% rates, and I can see the impact that it's had on their budget. I'm like, fuck, this is like probably how the US is right now, right? Like imagine we had a 30-year locked in mortgage or even like something smaller, but for a longer period of time, like things would probably be pretty good right now, right? But it is what it is, man. Yeah. So aside from that, I'm kind of stuck in a limbo, literally just waiting to see if my offer gets accepted. I got to give it another week or so, right? And then from there, I'll have to kind of chart my next course of action. Private loans, that's another beta mez. You got one through me as well that we got to get into a renewal. I've got another one that's trying to pay out. Lawyers have been the bane of my existence recently, but, all minor issues that will get sorted out. And, that's about it for me.
Is this the same offer over the past 2 weeks?
Yeah. Waste of time.
Cool.
So we tried giving him preemptive. Not that it was like a crazy offer, but I was just like, man, I really don't want to wait a month to make this offer. We have an offer date, but now I'm waiting a month. So it just wasted a lot of time.
So that offer that you're talking about, that was from the past 2 preambles, same one?
Same one. Yeah, they had an offer date. I really didn't want to wait for the offer date purely for the reason of like, okay, like this is capital that I'm now like going to tie up. And if it doesn't even get accepted, like I've now wasted a couple of weeks worth of deals, right? But ultimately I got stuck waiting. It is what it is, but I don't know if I talked about this on the previous preambles. Maybe I did. But my partner on that one, he used to, did I tell you about this or not?
No.
So my partner on that one, if our offer gets accepted, he used to be my tenant in my house in Scarborough. He used to live in the basement of that house.
That's fucking insane.
It's crazy. He's a new immigrant tenant. Came, lived in the basement, had roommates, started up an active business. Active business does really good. Moved out to Kitchener. At that time, I told him I was a landlord. Before that, I was just like, yo, fucking landlord's a dick. I don't know what to tell you, right? But then I told him I was a landlord when he moved out. Then he started following me on social. And then we just chatted over the years, and he's got a good amount of capital, and he lives in Kitchener, and we will, if this offer gets accepted, we'll be doing something together.
That is insane. That is insane. He's probably listening to the podcast, so shout out to you as well. What a story. I mean, the last thing that I want to touch on before we jump into the podcast is you had a pretty spicy couple of stories yesterday, man, about bankruptcies, risk taking, et cetera, et cetera.
Yeah.
Like, let's keep that same energy. What do you mean by that, dude?
We've talked about this, right? Like, I personally think, okay, you have two options. You can either risk it or you can do nothing. If you do nothing, you're going to fall further and further and further behind, right? Like, I think Canada as a whole is a very risk-averse country, right? Like, compared to the US, which promotes risk-taking. I don't know exactly like what the bankruptcy terms and stuff like that are in the US, right? But the culture as a whole promotes way more taking risk, right? There's more debt options towards like limited recourse options on just your business and stuff like that, right?
There's like the SBA loans as well there, right?
Yeah. And like, look, we've started having like BDC and stuff like that, and the government of Canada come out with all these different loans to help businesses invest in themselves. And there's, the CSBFL loan, which basically allows you to access, a couple, like $500 to $1 million pretty easily with only about 15% of your own like personal guarantee. Right. So in theory, you could get $1 million for your business and you're only at risk for about 150. But of course, the people that take advantage of that are the ones that are trying to do some sketch shit, right? But the intention on the government's part is good because it promotes investing into your business, right? And taking on risk for limited recourse, right? But the US has that plus steroids, right? So, I do think as a country, we need to be more risk taking. Now, you cannot fault the people that take the risk and then it goes wrong. Where you can fault them is if they are operating some level of a Ponzi scheme, right? And if the writing is on the wall and they should have known and they continue to raise debt, right? That should be faulted. Aaron Bay actually had a really good story about this, and it was kind of about predatory lending, right? And is there really no fault on the lender side, right? Like as a lender, we need to do our due diligence. We need to assess the risk, right? If the borrower is withholding information, that is different, right? But we need to assess our risk of the information that's provided to us. Does this loan make sense? Does it not? Are we comfortable with the rate of return that we're getting relative to the risk that we're taking? If it's an equity partnership, you need to read the documentation. You need to do your own due diligence on the deal and ARV and purchase price and renovation budget and stuff like that, right? And if you don't want to do any of that work, you should be in the mutual fund space or investing in REITs or investing with exempt market dealers on deals that have already been done due diligence on, and you will get a lower rate of return for that. That is my long-winded answer to your question, Austin. But what is your stance on this?
Yeah, I don't disagree with Canada needs to promote risk taking. I think we chatted about this as well. I don't know if that should be in the space of real estate, which is a not productive asset.
Yeah, agreed.
Right. Like in the US, the risk taking is more so starting something new where it's going to build into the productivity instead of, again, just reinvesting into housing. That being said, I agree with their sentiment. I think things are a little bit different in real estate because we know how the industry works. Like people raise to get themselves out of trouble. And to your point, it's the Ponzi scheme. But I do agree that the borrower needs to take some sort of accountability. You and I have private lend. Some of it has
gone. You mean the lender or the borrower?
Sorry, the lender. The lender needs to take some sort of accountability as well. Me and you have the lens as well, and it's gone sideways, and I can't help but to just crack a smile at it sometimes, right? So like, we knew what we're getting ourselves into. And I think it's the same with every single lender. You need to understand the risk that you're taking. You don't do due diligence. And we sound terrible saying this, right? Because like a lot of these people,
I don't think so.
I will say, no, we sound terrible because a lot of these people have mismanaged and there's a lot of fraudulent activity going on. That's different. Like you can't control stuff like that, right? But just generally speaking on a going forward basis, it's like you need to make sure that you're digging into layers of understanding what assets these individuals hold, what collateral you're getting. Promissory notes do carry significant amount of risk. Real estate is very cyclical. Yeah. And realistically speaking, if someone gets caught off the cycle, I mean, we've seen it with Van Dyke, right? Like these are established large developers and you're talking about, I don't know if it's hundreds of millions, definitely tens of millions of promissory notes have vanished. Right. And then that's because, and they've had, again, a very, very solid track record. 2 projects have gone wrong and that's rolled over into everything and they just can't pay anything back now. And now you're having the vultures buy these developments for very cheap. But that being said, like even with the most sort of strong developer, I want to say strongest developer, even with stable developers out there, they get caught offside and all these promissory note investors will end up losing money. These are the risks that you take. Right. But anyways, like I do feel for anyone who has lost money and has put their entire life savings into it, because at the same time, we know and a lot of investors are sort of salespeople where they will have you overcommit. Like, they're not like mortgage brokers where they're looking out for your best interest. Sometimes they'll have you overcommit the amount of loans. I've heard one that convinced them to try to sell their house to take those funds, rent, and then invest with them. Right. So you have a lot of those stories, especially on the smaller mid-sized scale. Right. But to a certain extent, there's a lot that goes wrong on the borrower side. But as lenders, we need to sort of step up and take accountability as well. Anyways, we're probably going to get a lot of fucking hate for that.
I don't think so, man. I think a lot of people agree. Like, I understand. Like, and it goes back to this. We have loaned on multiple deals, and we have our low risk deals where rates are commensurate to the level of risk. And we're like, you know what, anything above like 10%, like we're pretty good with the low risk deal, right? Because especially if the GICs are paying 5 or 6%, right? And that's zero risk, then for a low risk deal, something around 10 to 12 is like pretty fair, right? Then we got our medium risk deals where, we might need to be at like 15 to 18% for it to make sense. Then we got our high risk deals where it's got to be at least like 20 plus, right? So if you take, A, you got to make sure your risk and your reward makes sense. B, if you're entering into a high risk loan where you're doing it because the reward makes sense, you can be upset, but you cannot like, you've accepted the risk, right? As part of that reward, which I think a lot of people refuse to accept the risk, but they want the reward. And that is where the problem kind of lies in our little real estate ecosystem, right? But enough about that, man. I think this is
one last thing.
Fine.
Again, I think we should just make it very clear that we do sympathize with people in this situation because there are a lot of bad actors, people who continue to raise who shouldn't be raising, et cetera, et cetera. Like sort of the point that you mentioned where it becomes a Ponzi. I know a lot of people get stuck in that situation. And for that, we have a lot of sympathy towards that. But again, like that due diligence, the things that you mentioned before. Anyways, now we can jump in. Go.
Also just nicer than me. But all right, guys. So this week's episode is with Ali Nazarian. For anyone that doesn't know Ali, I had the pleasure of hearing him speak a couple weeks ago. Very knowledgeable on the entire commercial space, ground up development. His first deal, unlike us, was he bought a parcel of land, or not a parcel. He bought a lot of land, like a lot. And then he developed I think it was 2 semis on that, if I'm not mistaken, right? And so he went from that into kind of commercial deals and doing more land development. But he's a very ordinary individual, good paying job, has an engineering background. He understands the development space pretty well, right? And he's a really good case study. So it was just me on this episode with Ali, had a really good conversation with him. It was basically just a one-on-one coaching call as far as I'm concerned. And I had the ability to ask him a lot of dumb questions. So hopefully you guys enjoy the episode. He's a world of knowledge. Make sure you guys go check him out as well. His company's name is EcoLux Developments. Pretty sure you guys can find him on Instagram as well, Ali Nazarian. So make sure you guys go show him some love. And if you guys enjoy the episode, as always, make sure you drop a 5-star review on wherever you listen to this podcast episode. What's going on, Ali? It's nice to have you on the podcast. I know we connected a while ago at Corey and Danielle's event, and you're a busy guy, tough to get a hold of. But for anyone that doesn't know you, why don't you give us a quick background on yourself, who you are, and what you do?
Thanks, Mayo. Thanks for having me on the podcast. You guys do an amazing job educating people and really interesting topics and networking events. Yeah, but like I said, my name is Ali Nazarian. I am multifamily development and value add, I would say investor, and with a focus on energy efficiency and really maximizing the benefits of the MLI Select program. That's kind of in a nutshell. And then we help investors who want to get into multifamily investing, but they don't want to deal with tenants and contractors and honestly engineers.
Yeah.
So, we help those people invest passively in the multifamily space as well.
Yeah. And just looking at your website, I know you guys have projects all over the country now and you do a whole bunch of stuff. But for anyone that, doesn't know the origins of Ali, you come from an engineering background. How did you get into this space? What were you what even kind of led you down this rabbit hole?
Yeah. So that's a common question I get. And so since I was a kid, actually, I was really intrigued by new homes being built. We lived in an area that there was, a lot of new developments happening. And the fact that like you had a piece of dirt and then somebody had an imagination and they would somehow put that together and build a home that people would live in and like have memories and, call home. It was fascinating for me. And that's honestly what got me into engineering, because I like to build things. I didn't end up being a civil engineer. I ended up becoming a mechanical engineer. But this passion always remained for me to build. But I never really acted on it until I was in Edmonton in 2015. And I was working in the oil and gas industry as an engineer, like project engineer. And for those who were following, I guess, the market in Alberta or oil and gas, they knew that the oil and gas industry took a major nosedive in that year. And basically, a lot of companies went bankrupt, including the company I was working for. So I found myself without a job, sitting at home, lots of time on my hand. I kind of, then traveled for a little bit, enjoyed the first few months of freedom.
This was 2015?
2015, yeah.
Okay. You'd already been working for a couple of years in Alberta, or?
It was just a year and a half. So I moved to Canada in 2012.
Okay.
I did my master's in Newfoundland, actually, of all places.
Yeah.
And then moved to Alberta in 2013.
Gotcha.
And I was working for like about a year and a half. And I mean, things were a little bit shaky earlier on as well. But 2015 was like when really things got bad in the oil and gas industry. So there was really like even no jobs to apply for. Like for those who were in Alberta, they know this. And companies were laying off people like thousands at a time. It was pretty bad. So naturally I started thinking, okay, what else can I do while waiting for the market to turn around? Believe it or not, I tried my hand on photography business for a while because that was a hobby I had, but quickly realized I'm probably not going to make much money or enough to live off on that. And then I kind of turned back into my passion for building. So I started talking to people, putting pieces together. And City of Edmonton was actually promoting infill developments at the time. They were really promoting like putting 2 units on a single lot. They're now allowing 8 units for those who don't know. So they were actually educating the public. They had a lot of like pamphlets and like, presentations on what's the process of doing an infill development and doing a severance. So I really got my first education in land development from the free material the City of Edmonton was putting out. And for anyone out there that's trying to get into this, there is always a lot of free material on a lot of cities' websites. I mean, some cities are better than others, but Edmonton is actually pretty good in that. From what I know, they're still doing that. So anyways, that's how I got into that, started looking into it, tried to pull off a partnership, but I didn't know anything about how to do JVs or partnerships at the time. So it didn't work out. But as soon as I got back to job in 2016, I started investing in real estate. I knew I need to do things differently. Like the job that we have is never a real security.
Right.
It's a perceived security, but the industry can tank, your company can go bankrupt or whatever. So anyways, that's how I kind of like started investing in real estate. And then in 2017, I was living in a small town in Alberta. I actually jumped right in. I bought a piece of land and started doing a project on my own, is building a house and with a basement suite that I actually still own it and had the first tenant turnover after 5 years. So that's kind of the nuts that I got into real estate and development. So I'll leave it at that. I'll let you
that's a lot. First, I'll say, I know some photographers that it's crazy, especially in the brown wedding community. If you're a photographer, you make some crazy bank. So I don't know which one would have paid more. So, but that's okay.
Yeah. It could have, yeah. But you're still you're making money based on the hours that you work pretty much.
True.
That's true. There are some photographers that make really good money.
Yeah.
Just the path didn't seem as straightforward for me at the time.
No, for sure. Right. And I think it depends on the market that you're in and kind of timing and where you're located and stuff like that. But ultimately you're killing it in this space. So that bet kind of paid off for sure. So I just want to quickly go back to Edmonton, the market as a whole, because we've had other guests on here, realtors, investors, people deep in Edmonton. You're obviously, you do projects across Canada, right? Just based on your website. I see St. John and Thorold and quite a few different
Alberta, New Brunswick and Ontario.
Yeah. So Edmonton, I had always heard that it was 08, 09. That was a real crash in Edmonton that took us almost a decade to have recovered from. I didn't even know there was a 2015 crash, right? So that's really interesting. What are your thoughts, I guess, not to jump ahead and jump all over the place, but what are your thoughts on Edmonton today as a market? Are you guys actively investing and looking there, or is it something that you've placed on the back burner? What are your general thoughts?
Yeah. So the crash in 2015, just to clarify, was in the oil and gas. The real estate market in Edmonton didn't really took as much a hit as much as the valuations are concerned.
Right.
Edmonton market is known as the steady Eddie. It doesn't appreciate much, but it also doesn't depreciate much. It's, I guess the closest we can compare it to is Ottawa. Because of the government, all the government jobs, it gives it a little bit more stability. Edmonton is also a manufacturing hub, and it's a gateway for all the northern areas, like with supporting the oil and gas and manufacturing in the north. So that gives it a little bit more stability. But yeah, that appreciation is not something you would bank on. Like, I guess as investors, we never bank on appreciations anyways, or we shouldn't. Right. And specifically in Edmonton. But in terms of where we are, I was actively looking about 2 years ago in Edmonton. We had a couple of offers that didn't go through. It is a little bit on the back burner for me right now. We're active more in Calgary market just because of the rent growth in Calgary and the tighter rental market. Edmonton is very pro-development, but there are two sides to that. It comes at a kind of cost as well. Is I can build an 8-plex on my property, well, so does my neighbor and everybody else on the street.
Right.
So you got to be careful with the competition, right? We always complain about Ontario being a difficult place, but difficulty means you will have less competition as well. So there's pros and cons. So for anyone that wants to invest in Edmonton or in Alberta in general, you have to keep that in mind that it is an open market. You don't have rent control. Rents can go up, but they can also go down. That's something in Ontario we never consider even when we're running pro formas, is that the rents can go down. But that can happen in Alberta in 2015, 16. In terms of, I guess, the valuation of multifamily properties would have gone down. I wasn't in the multifamily space back then, but the rents went down quite a bit. I would say like on average 10, 15%. In some smaller markets, 20%. So I know there's a lot of hype about Alberta, and I think it's a great market to invest in. You got to be careful and do your risk assessment on the long run, especially. All indications right now seems like it's upward pressure on rents and prices and immigration, but it has not always been like that.
For sure, yeah, and I think that's a really good point. Like ultimately, especially people buying newer builds in Alberta, if we think about a recessionary environment and potential rate cuts, and is a new build really a necessity, or do I just need a place to live that has 2 bedrooms, right? So in terms of what's the most recession proof is also something to think about there. So no, that's really good. But I didn't expect to talk about Alberta. It's just normally we have investors and realtors that are from Alberta and heavily incentivized for or biased towards Alberta, right? So it's just a really good perspective coming from you as well. So I want to get into kind of that first property that you bought. Makes a lot of sense. You got laid off. My story was very similar. I got laid off in 2019, and that's what led me down the entire deep rabbit hole, or 2018. That's what led me down the deep rabbit hole of real estate investing. But you started off in something that most people would never start off with, which is a ground up new build house that you built yourself, right? So what was that process? You also said it was a small town in Alberta, which is even more odd because you would expect it to be in a decent sized city, but what was that deal like? What was the process of getting into it? What was the due diligence like, especially for newer investors listening today that want to do the same thing, right? Give us a roadmap there of that first deal.
Yeah, it was really like I mentioned, when I was in Edmonton, I was trying to do that in Edmonton together with some friends, and we just couldn't pull off the partnership. We just didn't know how to set it up. So eventually when I got this job in a small town called Lloydminster, it's a border of Alberta and Saskatchewan. After a year, I noticed there are some lots available. You're familiar with the city?
I saw. I don't know who had this. One wholesaler had a deal in. I'm pretty sure it was Lloydminster, and I had to Google it, and it was 5 units for $250,000 or something like that. But it was right at the border town.
Yeah, 30,000 people in that city. So it was something like I kind of started educating myself in 2015. looked at like, how do you build a house? Where do you get the permit? How do you some cost, trying to figure out the cost estimates and all that stuff. In 2017, the opportunity was, I saw there are some lots available. So prior to 2015, the market was so hot in Alberta, you could not get your hands on a new build property. You would have to buy it on the plans and then get the builder to build it for you. And this city was like obviously a very oil-centric city. Was not an exemption. The city could not build new subdivisions fast enough to put houses on the market. Right. I heard my boss that in 2015 or 2014, when they were trying to buy a house, they had to buy it. And then the closing was a year later for the builder to build it for them. And then they had sold their house and their closing was also a year later. So the buyer was waiting a year before they could move in. But then a lot of these builders, they got these lots, but then the market stopped. So they had them on their hands. So I literally started driving around, taking the numbers from the signs on this lot that were mostly meant for purchasers to buy it, basically to be built for them. And I just called them and say, would you sell it directly to me? And I knew exactly how much they bought them because they bought it from the city, that the information was available. And it was like $137,000 what they paid. And I was offering them about $125,000. We ended up at $130,000. So I bought the land. The other thing that triggered me to do that was, again, because the economy was slow at the time, banks were actually promoting construction financing. And I saw this ad driving on the street from a local credit union saying like, oh, get a mortgage to build your house. I'm like, looks like all the stars are lining up for me. I've been wanting to do this. And I didn't own principal residence in Alberta at the time. So I could qualify as an owner builder. Right. But I approached the bank and it was really like just figuring it out along the way. So they said, yeah, we'll give you a mortgage to buy the land and then you can get a construction financing. You have to do basically the estimate and whatnot. So I kind of like just asking around, figured it out. And I did project management for my day job. So I basically took this as another project and applied those project management principles to it. I also decided to be my own GC so that I wanted to really learn on my own dime how to do it. And my thought process was, if this goes south, I still have a well-paying job that, I can fall back on. Even if I lose money, I'll be okay. So that was the thought process. And I think that's something for people to keep in mind when you ask about like newer investors going in, is to always have a safety net. If this plan doesn't work, if this deal doesn't work, if you end up losing money, what is the worst case scenario? And are you prepared for that?
Yeah.
For me, it was like, okay, if I lose 20, 30 grand, I'll take that as an education, as if like I did another master's, right? And it was like that. It was a really steep learning curve. Like being in a small town really helped because the driving like from my office to the site was like 10 minutes. So I could always run out if I needed to meet someone on site. Right. So through the thought process, and I started like basically just asking people, other people who have built, and I had some friends who were in construction business. So that was also help. So again, it comes back to your net worth being your net worth. So that was really helpful. And that's how I kind of got it off the ground, and lots of learning, but got it done.
No, that's pretty cool. I like to say the same thing. It's just like, if you're okay with the worst case, obviously no one ever wants to lose money. No one wants to make a marginal return, right? But if you're okay with that worst case scenario, then you'll be okay, right? Like in the long term. So that's good. Just one last question on that. What was the total amount of capital that was required on your side to do that first deal, right? Because it's land, 130. I'm assuming maybe you got some financing, maybe you didn't, and then a portion of the construction cost.
It was a while back, so it was 2017, but I think I got the 50% loan to cost on the land, okay. But it was all part of the construction financing. So the way it works, like they give you a land loan, and then I would have to qualify for the construction mortgage, basically, which comes in draws. They gave me a land loan per se to purchase the land, so then I can get my building permit and all that. I guess what I know now, I could have asked for a longer closing on the land, given the market conditions, to get all that permits and everything. So then I can go straight into construction financing. And in the construction financing, you will have a special draw before your first construction draw that you can pay off any mortgage you have on the land. Obviously, This can change slightly between lender to lender, but my overall capital injection into this was about $100,000. At the time, I had some like line of credits and stuff that I had to show that I have some liquidity. So that's one thing that's important. When you get into construction, there is an equity requirement you have to show, but there's also a liquidity requirement. And that liquidity requirement is to make sure you can pay your trades before your next draw comes in. Because again, the construction financing comes in draws. Yeah. If you're doing single family home construction, it's usually like 4 draws based on the completion. They'll send an inspector to look at the progress and then they'll release the funds. If you're doing a commercial, like multifamily development, that can come in multiple draws. You can do it like monthly or every other month, basically.
Yeah, essentially, they normally charge you a fee for each draw, and so the draw has to be worthy of the fee that you're going to incur, the lender and the legals, right? So that's pretty cool. That was really good context on the first one and kind of showing people how to get into their first build. The 100,000 back in 2017 today might be closer to like 200-300K, depending on where and what you're building, right? At the very least, right?
Yeah, to that point, when I say like Alberta, like the appreciation, I just did an appraisal on that. I think on my all-in cost to that was about 500,000 for 90 with the finished basement. At the time, that's what I could get for it on the market at best. And if I had to pay realtors and whatnot, I would probably be at a loss. I just got an appraisal for I think it was like about 540 now. So the appreciation in Alberta is not, again, something that you would bank on. And again, this is an appraisal. I don't know if I was to sell it on the market, what it would sell. Actually, the neighbor just sold for 540, but that's brand new. They just built that. That's just to give it context. So that the numbers like in Alberta don't change as much through the couple of years. Even if it goes up, it can go down but once the market cools off.
Well, here's my thoughts on the ground up development. Even in Ontario, we'll talk about some of the projects you have coming up as well, because those will be really to break down the numbers on. But very rarely does it, when you consider how much time and effort you're putting in, and then the risk associated with development, it's, hey, could I have made a similar return maybe somewhere else? And maybe I'm wrong about saying this, and maybe it depends on the developer and how good they are as well, right? But for the average Joe, it's like, hey, why bite off more than you can chew? So for a long time, like we never did conversions, myself and Austin. We just didn't even bother with conversions because it was quick in, quick out, cosmetic burrs. That was our thing, right? And now today, when I'm looking for things that we can develop or redevelop down the road and stuff like that, I know the numbers don't make sense per se when I run the numbers, but I also now value the fact that you have a brand new asset that's going to attract AAA tenants and it's going to have limited to no capex or repairs for at least 5 years, probably 10 years, right? So when I compare that to some of the 100-year-old buildings and the shit that I deal with on those ones, right? That's where there's a lot of like, what do I want to own for the next 30, 40 years, right? So it's not always just the numbers, but jump ahead to kind of like all the stuff that you're working on today. Give us kind of like a quick rundown. So you did that first project. What were some of the projects in between? Because today you're doing some big shit.
Yeah, so I moved to Ontario in 2019, and so I initially tried to sell that house, like I mentioned. I got started like, okay, I'm not gonna make money, I might lose money. I ended up renting the upstairs and downstairs. I guess smart thing that I did was like getting the permits for the secondary dwelling unit in the basement and having 2 units. And I'm actually doing furnished rental in the basement. I've been doing that since 2019. And when I saw the cash flow, that's where the light bulb went on my head. I was like, well, I can just build purpose-built rentals and not bother with selling them. So when I moved to Ontario, I looked at doing the same thing, but I quickly realized the numbers don't work in Ontario, given the land price. Yeah. And I started learning about, severances and using that to lower the cost base of the land. So I did some severances and then I kind of attempted some, like land assemblies and whatnot. So I did like an infill development. And then from there, basically realized that, doing a bigger project is almost the same amount of work than a smaller project. Doing a 4-unit development versus a 10, 15, 16 unit, it's not all that much more work. And it sometimes gets easier when it's bigger because it's worth the time to hire bigger consultants. You don't have to do all the work yourself. So like I said, I did some severances in like Niagara area, and some land assembly. And then from there, I took another big jump. And again, I'm not recommending people to do that, but I partnered with my current business partner in New Brunswick, where we had a sixplex on a 2.5 acre land. So that was my kind of stepping into multifamily space and combining that with land development. So at the time, I've taken some education in land development. I kind of felt more comfortable with like how the rezoning and subdivisions and all that work. So we jumped on to that one in New Brunswick. It's been a great market. We renovated the sixplex. It's one of those 100-year-old buildings.
Yeah.
We actually did energy efficiency upgrades on that one and qualified under MLI Select for a 50-year amortization and, 95% loan to value, and managed to pull out most of our capital from that project. And now we're going through rezoning the land to add more units. We actually had a meeting with, it's called the Envision St. John. It's like a government body that supports developments. And we are looking at a potential 86 unit development on the additional land that's on that property.
Is this a Westmoreland project?
Yeah, Westmoreland project. Yeah.
Okay. And so I see that on your website. Anyone that wants to look, check out his website, EcoLux, EcoLuxDevelopments.com/NB. But, so I see here, so like how much was the sixplex worth in St. John's after you guys had done the full energy efficiency and all the work on it?
We bought it for $670 and the appraisal was 1.32. So 1.3 million.
Very good. But I guess you had 2 acres of land on that as well. Okay. So the land is also
the land doesn't actually come into the valuation because that's just income based.
Right.
So,
yeah.
And that's a good segue to like, my projects in multifamily. And that was really a proof of concept for me with this energy efficiency and NOI optimization. So I take a deep dive into the NOIs and where we can add revenue and lower expenses. One of the things that we did in that St. John project, and we're doing it in every other multifamily value add that we're doing, is transferring the utilities to tenants as much as possible. Submetering the water, submetering electricity. We're cutting gas or anything else like in the buildings. Typically, we electrify the buildings. Is one of the ways that we achieve the energy efficiency and GHG emission reductions requirements for MLI Select program. So we add basically value that way. We also do things like, providing Wi-Fi for tenants and charging them a fixed amount. And we make this spread from like, we get the bulk connection per se, and then distributing that between the tenants. So we do things like that to really push the value up and lower the expenses. So that was one of the things. And also the rent improvements, like the renovations, kind of like typical what we do. So that's where we were able to push the value up to 1.3 million.
So yeah, I'm just going to stop here. So for anyone that doesn't know what we're talking about, because I realize we never actually, I'm sure in previous episodes, we've explained MLI Select and all that stuff as well. Yeah. But basically government-backed insurance project that allowed that exists for commercial loans to be refinanced up to 95% loan to value and up to a 50-year amortization, as long as you meet 3 government kind of incentives, right? So the first is accessibility, which, if it's convenient, you can do it, right? Affordable units, which depends on the market. Sometimes you do it, sometimes you don't. And then energy efficiency, which is what a lot of people have been targeting, which is what Ali was talking about right now. You need to basically, to get to that full 95% and 50-year amortization, you need to be, I think it was a 40% reduction in energy consumption, right? From when you buy it to when you refinance it.
Yeah, 40% energy efficiency improvement and 40% GHG emissions reduction.
True. Yeah.
People sometimes forget the GHG emission reduction part, but that's also a requirement. Sometimes you have to overshoot on the energy efficiency improvement to achieve the GHG emission reductions.
Yeah, I think for most people, the energy efficiency auditors just come out, they tell us, hey, do this, this, and this, and some combination of these 4 things will get you there, and then we just go, cool. Like, don't tell us anything else, right? But it's good that you got this level of understanding. I just want to understand. So for Westmoreland, you guys have done the refinance, but I'm looking at your website. It looks like you guys are planning to build a pretty big L-shaped building here.
Yeah, that concept that's on the website, that I actually need to update that. But so that's interesting. So that's some of the challenges in the land development. The concept that was there was initially was to demolish the existing house and build a larger kind of an L shape at an angle at the street spot of the lot. But when we did the community engagement, so as part of the process, before we go through rezoning, it is highly recommended to do a community engagement to get feedback. That will give you basically support when you go to council or you go to committee of adjustment or anything like that, to basically get approval and say that, okay, we have listened to the community. When we did that, actually, funny enough, it started a pretty big, storm, NIMBYism. And we actually ended up on a CBC article and talking about, this Ontario developers coming to St. John to destroy our history and whatnot. The building was not registered as a historical building. We double and triple checked that during our due diligence period. But the community had some, attachment because it's a pretty old building. It looked quite nice. Like it could, it didn't qualify quite as a historic building, but I guess people saw that as a landmark in their neighborhood. Yeah. So we got a big pushback. There was a petition against, the application with 900 signatures and whatnot. So we basically listened to the community. You never want to swim against the current.
Right.
And we basically listened to them. We went back to the drawing board and we came up with a plan where we can keep the existing building and then build around it. Makes the construction a little bit more challenging, but it worked out at the end. Like it was about the same time that the MLI Select came out, and it allowed us to implement that and basically get our capital back. So what's on the website is the initial concept. We have a different concept now that we're just kind of finishing up, and I will be updating the website, which basically keeps the building, and then in front of it at the street, we will have a bigger building, and then we'll have a bunch of townhouses on the back side.
Oh, that's pretty cool. Yeah. Okay. So you're essentially not tearing down the initial structure, which means it probably makes your financing a lot easier as well, right? Because you're kind of just getting the land for free if you guys sever it or if you decide not to sever it.
Yeah, exactly. Yeah. The land ended up being pretty much free for us. I mean, except all the fees we have to pay to get the rezoning done and whatnot.
Yeah.
But yeah, it ends up being a much lower cost than if we were to basically buy the whole thing.
Yeah, no, that makes sense. So I know you guys have done a couple more projects from there. So let's go through those ones. So St. John, New Brunswick, that was the first, or I guess the second kind of like ground up development in the multifamily space. Where did you guys go from there?
So we have one in Alberta now. We did a land assembly and we rezoned it for a tower. To allow for a tower doesn't mean that we're going to build a tower, but we push the density up. So we just finished that and we're looking at possibility of, developing a multifamily on that one. And from there, after the experience with the Sixplex and the MLI Select program, I started getting into doing more value add, like multifamily value add projects. So we did a 9-unit value add, basically renovations, MLI Select program in Oshawa that we're just wrapping up. And then we're doing one in London now that is a combination of development and value add. So basically, we looked at the property and we realized there's a big land there. And when I looked at the zoning, we realized the zoning allows 5 additional units without requiring any rezoning or anything. So the land was not at its highest and best use. So basically what we have done is we are renovating the existing building, but we're adding another floor and adding more units. And we are actually going back to get a minor variance to chop up some of the units inside the building as well, and basically go from 9 units to 16 units. So it ended up requiring site plan approval and all the things that you do with a new development. Yeah. So it's kind of a hybrid of multifamily value add and development, but just instead of having a separate structure, we figured that it's more cost effective to just add to the existing building.
So let me ask you this on that one, because I see the picture of that as well on your website. It's a perfect kind of like or if the picture's the accurate one, it's purpose-built multifamily that you would normally see in a lot of large cities across Ontario, brick buildings, flat roof, right?
You guys have a story walk up. Yeah.
Yeah. So this is like the perfect, you see a lot of this in a lot of cities. So it's a perfect example. Yeah. Can you do what you guys did? Like, I understand inside you guys have renovated as well, like the existing structure, but can you add the fourth floor with tenants staying in the building?
No. That would create a lot of like safety concerns.
Safety issues? Okay.
You might be able to like, you know, it make it difficult. I wouldn't say it's impossible, but it makes it challenging. One thing is because you need to, if the building is old and you don't have the drawings for the building, you pretty much have to as-built this structure. That's the term they use, is like they have to go in there and physically expose the foundation, the structures, not all of it, but they have to cut openings in the floor from outside or inside to expose the foundation. And the engineers basically have to reverse engineer the building to determine if you're actually allowed from the structural perspective to add additional floor, because that adds weight to the foundation. In our case, we were lucky that this was allowed, but this is a kind of part of the due diligence to do a project like this. If you have the drawings, sometimes in some cities, they have good records of what was originally submitted to the city. That then you might be able to do that while the building is occupied, get your permit, and then you would definitely have to have the top floor vacant, because that's where the construction is going to happen. But it will be very challenging to connect the systems between the two buildings. It's also, when you do this, you will have to bring the safety features of the building to today's code. So the fire alarm system and some of like the water supply and things like that is to be brought to code. So that creates a little bit of challenge. So with this one, we evacuated the entire building, and we actually got the last tenant out just like a couple of months ago. And we just received the building permit, so we're ready to start construction.
So are you evacuating the building by serving the notice for, I can't remember what the end form is
called. Cash for keys, yeah. The cash
for keys?
Yeah, we did cash for keys. We also served N13.
Right.
You know, it was faster to do cash for keys. Also with N13, you know, in Ontario, for those who are not familiar with Ontario, the tenants have the right to come back for the same rent.
Right.
Plus a very small improvement. And in some of these old buildings, oftentimes people have been living there for a long time. So that would not be a good outcome if they decide to come back. So our last tenant, we actually had to pay pretty good money to get it. But yeah, it's for anyone doing cash for keys today, they know that's pretty challenging.
Yes. So it sounds like this isn't a viable strategy because a lot of commercial buildings, like you said, we buy them with under market unit tenants, right? And there's really no guarantee as to how many, if any, of these tenants you're going to be able to negotiate vacancies with.
That's right.
So it's not like you could just buy a building with existing tenants and assume, hey, worst case, I'll just add a floor on top, because you do need the existing structure to be predominantly vacant, it sounds like, to be able to add that. Okay. Gotcha.
Yeah. So it's a unique opportunity. It's something that we identified in this situation, but it's not a strategy that, you know, we would say, okay, this is our strategy. That's what we're going to go and do with every building. Something you can explore, but yeah, I wouldn't say it's like a strategy you can apply to every building.
Cool. So is the London one the last one that you guys are currently working on now, or?
That's the one we're working. I'm also like down the pipeline. I have a potential 8 to 10 unit in Welland, but that would probably be the next project. And then the Calgary one could potentially be somewhere 70 to 100 units, but that's still very early stage. It's probably the first time I've publicly spoken about it. So that's the land assembly we have there, but that's still in the early stages to see, you know, if it's viable. Like you mentioned, construction and building multifamily right now, it's very challenging. I think that's what I presented in the Corey and Danielle's workshop as well, is the money is in the long-term hold, especially the new build development. I think most real estate strategies today, there is no get rich quick scheme today. Right. I know maybe student rentals might be still, you know, a good cash flow. Maybe that's not my specialty, so I don't know much about it. But I don't think there's really any strategy that you can make easy money per se. But the one thing is for sure, that is a get rich for sure slowly in the long term. Right. And that is true for ground up multifamily development as well. In most cases, you're making, a little bit of profit on paper, but if you're using MLI Select program for the construction financing, there is no takeout at the end because they don't want to incentivize, people with money to go buy boats or whatever. So the money is in the hole. And the projects that we work on, we always look at least holding for 5 years. My plan would be to keep them long term. And you kind of alluded to it as well, as when you have a brand new building, you're getting the best tenants. You have the least amount of maintenance. The first year, you're under warranty from your builder or your contractors. So anything that comes up, they'll have to come and fix. And generally, you will have less issues down the line as well. So all in all, I think it's a better strategy beyond just the numbers and the profit that you make. And it makes for a better investment, better asset to keep in your portfolio.
Yeah. And, like I said, it's, I've owned some over 100-year-old buildings. And, the reason I'm looking at the space is, learning the lessons on the other side the hard way with regards to deferred maintenance, deferred capex, tenant vacancies, pipes bursting, electrical needing upgrading, and all sorts of shit, right?
Yeah, exactly. Yeah.
You've obviously got quite a few projects on the go. And the biggest issue for most developers that I see, and we've tried to help some out of these situations. So it gets messy, but it's essentially just being over levered, right? With multiple projects on the go, none of them really exiting today, none of them selling today, but all at various stages of SPA, groundbreaking, and the foundation pouring and all that kind of stuff, right? So how have you gone about taking on these projects? Have you self-funded? Do you raise capital? Is it more of a debt structure? What is your structure to kind of get into these projects? I'm sure it's evolved as well as you've done it, right?
Yeah, for sure. Yeah. The first few projects were self-funded. So, that's kind of responsible at least for other people's money, which is a huge responsibility that we take very, very seriously. It comes down to risk management, right? And I like to think my last few years in corporate world was in risk management. So I'm always thinking what's the worst case scenario? And are we okay with the worst case scenario? Like I kind of mentioned before as well. And it's the motto is prepare for the worst, but hope for the best, or plan for the best, but prepare for the worst. So it's been a mix of debt and equity. I know a couple of years ago, and that's probably where a lot of people are getting into trouble. A lot of people were preaching that why would you share the pie with investors where you can pay 12, 13, 14% on a promissory note and you keep all the equity for yourself. You pay them out when the project is done. Now you own the building for yourself. So that obviously is a very risky play because you're carrying high interest debt for a long time. And if you can't exit to pay them back, that's where people get into trouble. We have used a more moderate approach of sharing the pie. Some of our projects are 100% equity funded. Some are more manageable, mortgages, from lenders, not from private P notes or whatnot. And, at manageable loan to value. With investors, we have typically tried to use equity. There are cases that we do maybe 50% debt and 50% equity. I'm talking about funding the project as the owners, right? We all have the mortgage in place, but let's say if you have to come up with 25% or 30%, we do a mix depending on the project of equity and debt. So that's how we've been able to manage these projects. But yeah, we raise money from accredited investors, friends and family, business associates, as equity.
Yeah, no, I think that's important. There's a couple important points that you made there, right? The first is obviously a couple of years ago, everyone hyping up, going against basically the JV train, which I was against. So we did JVs aggressively in 2020. And then in 2021, we stopped doing JVs completely, more so just because you couldn't find a deal, right? And so if you can't find a deal, you got to make sure your capital is being deployed. And then in 2022, I switched up and I brought back the JV model because now the risk appetite had changed and there's more deals out there. So you can take on more stuff with more partners while managing your risk as well, right? So I think that's a really good point. It's just kind of the seasonality of it and even the debt and equity structure, like you said, different structures for different deals. There's no right or wrong single approach, right? So
depends on the size of the project, depends on, what you're trying to, what the goal is, what the exit plan is. Yeah, we have used GPLP structures. We have used corporate structure. So both. But one thing that's important is working with an exempt market dealer. Weird. That's what we do when we're raising capital from investors. We want to make sure that we're compliant with the Securities and Exchange Commission rules. That's a very, very important step that, unfortunately, I've seen a lot of newer investors overlooking that step or not taking it very seriously. We have had many cases where we had to turn down the investor. They have cash in hand, ready to invest, but we just can't allow them to invest in our deal because they didn't qualify. So we use an exempt market dealer to make sure that we are compliant in our capital raising. They charge a fee, but that's well worth the risk reduction again, because you do not want to be dealing with Securities and Exchange Commission. And so being compliant with that is very important. They can shut down the project. They can shut down all your finances if you're found to be non-compliant. And some of the high profile cases, not the most recent ones, but the ones like a couple of years ago, the first domino fell because the Securities and Exchange Commission started like picking on some practices that was not compliant. And they shut them down. So they shut down their operations, and obviously the machine can't move anymore, and they couldn't pay their investors. And that's where things started falling apart. So being compliant with Securities and Exchange Commission is very important. And the other thing that exempt market dealers do is they do the due diligence on behalf of the investors. So, and these are professionals, like they have literally the entire team and office doing this day in, day out. So the level of due diligence that they do on the projects is beyond what typical mom and pop investors can do. That's their duty under their license to the Securities Exchange Commission. So they're basically acting on behalf of investors. And that has made our lives a lot easier, because they also make sure that the investors understand the risks. That's a big, big part of the compliance with the Securities Exchange Commission is risk disclosure to investors. You need to disclose what the risks are. And if you don't know, then that's where, professionals like the exempt market dealers will analyze your deal, and they will come up with a list of risks, and they will make sure that the investors understand these risks. So if something happens, nobody can come back and say, oh, I didn't know this could happen.
Right? Is the exempt market dealer also raising the funds, or are you guys still raising the funds?
They can help. They can help with raising the funds. There are different type of exempt market dealers. There are some that they just facilitate the subscription process. There are some that they will also have some investors. Obviously, they charge more. If they bring investors, they charge a fee. There are some EMDs or exempt market dealers that they can literally fund your entire project. But usually the bar is very high. You kind of need to be an institutional level to qualify for them to basically fund your project. But for the average level investors, you can pretty much count on the EMDs for the compliance.
Gotcha. Yeah, no, I think we got someone on here, and probably the example for you that would make sense is if you guys end up going through with that 70 unit build on Alberta, that might be sizable enough for an exempt market dealer to come in and raise the capital, I'm assuming. Is that kind of the scale that you're dealing with?
So actually that land assembly was a GPLP structure, and we used an EMD to basically to help us with the capital raise.
Okay.
They brought some investors, but honestly, we brought most of the investors. Right. But again, use them mainly for the compliance. And also, like, basically, they double check our numbers of financial modeling. They run risk scenarios. It's just a different level of due diligence. Not that to do a favor to you. It's their obligation as part of the licensing to do that kind of due diligence. They call it Know Your Product, or KYP. So they need to know the project inside out before they allow investors to invest in the deal. So we work with them on that one. Our London and Oshawa project also is a shareholder agreement, so corporation, but it's also presented through an exempt market dealer. So any investors that come in, they will be dealing with the exempt market dealer and not directly with us.
Perfect. I know our episode is supposed to be 30 minutes, but we've gone way over time.
Sorry about that.
You're joining my one-on-one coaching call with Ali here.
Yeah.
But Ali, I'm gonna change up the last two questions that we asked a little bit. So for anyone that wants to get into the space of development and starting to do stuff that you're doing, how would you recommend they do that? And by the how I mean, like, would you recommend they go for a 4-unit in Toronto? Would you recommend they go for a multiplex in Alberta? Would you recommend they build something in Thunder Bay? Do a Severance? And I know Severance is easier said than done, harder to find, stuff like that, right? But I'm curious, what would you recommend to someone that's, maybe got 200 to 300, 400K in capital even? How do they get started in this space?
Honestly, I think the first thing they should look at is what is their skill sets? What is the market? What they're interested in? They need to pick their market first. I can't recommend Alberta versus Ontario. It depends on your strategy, right? Okay. If you're looking at cash flow, Alberta is probably better. If you're looking for the long-term appreciation, Ontario would be better, but there are different challenges there. Their comfort level with how much challenge they want to take on. So that I would say like that this is something I tell. So I do a little bit of coaching as well. This is what I tell my students is you got to look inside first. Don't look at what everybody else is doing and don't get caught in the shiny object syndrome. So look inside, see what is your availability in terms of money, time, and knowledge. Do you have the knowledge? Do you have the time? Like if you get into construction, it's very involving. Even if you're not doing the construction yourself, when you get to like larger builds, the coordination between all the different consultants involved is very time consuming. So you got to look at where you are on that scale of time, money, and knowledge, and where your comfort zone is, and then decide based on that and decide based on what your long-term goals are. There are opportunities everywhere depending on how you look at it. And yes, severances are a good way to get into land development and kind of get your feet wet, especially if you have a property on the site that can carry itself. You can do that on a larger scale. Like that's basically the project in New Brunswick I talked about. That's basically the same strategy, but on a larger scale. You have a sixplex that we can sever off from the land and develop the rest of the land, while that sixplex allows us to carry the property. So I would say like look at the risks, look at what is the worst case scenario and understand that. And I guess I'll kind of slide this in. I have a Facebook group called Housing Developers and Builders of Canada. It's absolutely free. We have monthly meetups where we bring people involved in the land development space. And, there's a lot of free education there. So they can join that Facebook group and the monthly calls for some free education.
Perfect. And then the second question, Ali, is, where do you see your business going in the next 2 to 3 years from now? Like what's next for you guys?
Definitely focusing on ground up multifamily development. I can't say like, how many units or what, because that kind of depend on, the environment. What's the interest rates? What's the financing options available to us? But it will definitely be multifamily purpose-built rental development to keep. I'm focusing a little bit more back on Ontario. And the quick reason for that is with the push for more housing across Canada, I think Ontario would be the last province to get out of the housing crisis. And as much as the housing crisis sucks, but if you look at it from the business perspective and the demand for rentals, I think the demand for rentals in Ontario will not drop anytime soon. And we know all the things, without getting political about the political environment in Ontario and all the laws and regulations. I think we've got a big enough a mess on our hands in Ontario that the difference between the demand and supply, especially for rentals, is not going to go away in Ontario.
Yeah, I forgot the theme before when you were talking about Alberta and Edmonton and pro-densification. While that's great if you're developing, it also poses a risk, which in Ontario, the lack of development, as much as it sucks and it's terrible for the province as a whole, it really protects our investments, right? And that's what a lot of people don't acknowledge openly. But thank you, Ali, for jumping on the podcast. It's been a great episode. It's definitely been a longer one than normal. But if anyone wants to connect with you, what's the best medium to do that, and how do they kind of follow along for the journey?
EcoLux Developments on Instagram, Ali Nazarian on Facebook, also Housing Developers and Builders of Canada Facebook group. those are the best ways to reach out to me. Also, EcoLuxDevelopments.com is my website.
Yeah, if you guys ever have an opportunity to listen to Ali speak, he's definitely a great presenter. He's got a lot of cool case studies and a lot of knowledge to share with it. Thank you again, Ali, and hope you.
Thank you, Maya. Thanks for having me here, and we'll see you around.
For sure. Thanks, Ali.